Hello, we're going to cover material variances and direct labor variances in this video. And in the next one, we'll be covering the overhead variances. Variances are used to help with standards and for control purposes to see if we're using too much material, not enough material. And don't think of variances as being bad or good. They're just variances, and they raise more questions than they answer. Okay, that the idea is this is why are we using more, why are we using less? And what I have on this page is the variances that I use. This is the chart I came up with right here. And this is a standard quantity. Now the standard quantity is calculated by the number of units you actually did produce times what you should have used for material. And that gives you the standard quantity that you should have used. Then you take that times the standard price. And then on this one here, you take the actual quantity used times the standard price, and the difference between these two is the material quantity variance, and that can be favorable or unfavorable. Now the way I have this set up, when you subtract them going across, if it's negative, it's unfavorable. We don't show positive and negatives. It's just that it does come up negative, it's unfavorable. So if this one's larger than the standard, it's unfavorable. This one is for the purchase of the material. So you take the actual quantity purchased times the standard price that you have set, and this is the actual quantity purchased times the actual price, and again the difference between those two is the material price variance, and it can be favorable or unfavorable. And we're also going to be doing a labor variance. Okay, this tells us how much labor we used versus how much we should have used. And the standard hours allowed, this is again the number of units that you actually did produce times how long it should have taken for each unit, times your standard wage. And this is the actual hours worked times the standard wage, and the difference between those two, again, the absolute value of them, is what they call the labor efficiency variance. It can be favorable or unfavorable. And the last column here is actual hours worked times the actual wage, and the difference between those two is the labor rate variance. It can be favorable or unfavorable. And this last part, don't worry about right now. We'll get that in the next video. Okay, for an example, I have come up with second place company manufactures trophies, and the company has adopted the following standards for one trophy. For the direct materials, it takes 2 pounds of material at a cost of $1.50 per pound for a total of $3 per trophy. Direct labor takes 0.75 hours or 45 minutes, and if it's given to you as 45 minutes, you need to convert that to hours. So you take 45 divided by 60, and you get 0.75 hours, and that's at $12 an hour for $9. And overhead we'll talk about later. Okay, actual production was 11,200. For material, we actually purchased 25,000 pounds at $1.52 a pound. We actually used 22,300. Labor was 8,500 hours at $11.65 is what we paid them, and we'll worry about that next part later. Okay, again, this I always put in here for myself. Standard quantity times standard price, actual quantity, standard price, the difference is material quantity. And then for the purchase side, actual quantity, standard price, actual quantity purchased, actual price, material price variance. And a lot of times I'll just put SQ, SP, AQ, SP, that type of thing. So I just do it that way. Okay. So what we have now, we're ready to do this example. Remember, this is for the standard quantity that we used. So this is calculated. We actually used 11,200 trophies. That's how many trophies we actually produced, sorry. And each trophy, if you remember up there, takes 2 pounds per trophy. So then we'll take 11,200 times 2 pounds, or 22,400 pounds. That's how much material we should have used to produce 11,200 trophies. And we pay $11.50 per pound, so the cost to that should have been 22,400 times $11.50, or 33,600. Okay, we compare that to what we actually did use, which was 22,300 right there. So that's what we'll put in there, 22,300. Again, $1.50 is my standard, so we take 22,300 times $1.50, or 33,450. So equal ABS Now ABS is XL for absolute value. We take 33,600 minus 33,450, and that will give us $150. Now you notice this one is smaller, so that one is favorable. And this box here was for me to label it MQV for material quantity variance, and that's 150 favorable. Okay, so we used $150 less than what we said we should have used. Okay, now for the purchase, we purchased 25,000 pounds. Standard was $1.50. So we take the 25,000 times the $1.50, and we get 37,500. So that's 25,000. We actually paid, if we look up above, $1.52. So we take 25,000 times $1.52, and it's 38,000. And again, the difference is the ABS. The 37,500 minus the 38,000 gives you $500, and that's unfavorable. And that is the material price variance. Okay. You notice it didn't come up negative because I used the ABS function. We don't want positive and negatives. Okay, so again, what we'll do on this is we take the 11,200, which was the actual quantity that we produced, times the 2 pounds. That was our standard up here. That was our standard per unit, was 2 pounds. And then we take that answer times $1.50, which is our standard price, to get 33,600. Then in this one, we take the actual quantity used. This is the usage times $1.50 gives you, and the difference is $150. Okay. So now we're ready for the journal entries. Okay. So this is the journal entries is what we purchased. Material is going to go in at standard, so that's the 37,500. The material quantity price variance is unfavorable, so that will be a debit. If it was favorable, it would be a credit. And then the accounts payable is what you actually owe them, and that's the 38,000. Okay, for the work in process, that always goes in at the standard times standard, which is 33,600. Notice this material quantity variance is favorable, so that will be a credit of 150. And then materials at standard is 33,450. No should add up. So these are the entries that you would use to actually record. This is for the recording of the purchase of the material. This is the record. I'll highlight that. That's the recording the purchase of the material. This one is to record the actual usage of the material. And then if they ask you, this is for closing. So it's equal. If the debit's material quantity variance is a credit, you debit the account. And since the price variance was a credit, was a debit to start with, you'll credit the account to close it. And then the cost of goods sold is simply the difference to make it balance, or in this case, 350. Okay, this is to close out the variances. That's done at like at the end of the year, end of the quarter, whenever you happen to do that. Okay, now for the labor, we do the same thing again. We go back up here, we say, okay, we actually produced 11,200 trophies. So down here, we're going to put in 11,200 trophies, because what we're looking for is how long it actually did take us to produce this, how many hours it should have taken. Well, each trophy is supposed to take 0.75 hours, which was from up above, or 45 minutes, remember. And we take the 11,200 then times the 0.75. So these should have taken us 8,400 hours. Our standard wage was $12. So we have 8,400 times the 12, or 100,800. We actually used 8,500 hours. Standard, it was $12. So we take 8,500 times the 12, or 102,000. Okay, the difference is the absolute value. Again, we take the 100,800 minus the 102, and we come up with $1,200, and that is unfavorable. And this is the labor efficiency variance. Okay, so we're saying it actually took us $1,200 more than what it should have taken us. Okay, and this one is the 8,500. We actually paid them $11.65 an hour. So we take the 8,500 times the 11.65, and it gives us 99,000. Okay, now sometimes this number is given to you, and you can calculate this, but don't ever multiply it out and change this number if it's given. Okay, use the 99,225 if that's given. So equal ABS, the 102 minus the 99,025, and that's 2975. And you notice this one is favorable, and this is the labor rate variance. Okay, that's because we paid them less than what our standard was. Okay, now again, work in process is always at standard, so that's work in process. Now this is labor efficiency variance was a unfavorable variance, so that will be a debit of 1,200. The labor rate variance was a credit, so that will be was a favorable, so that will be a credit. And then wages payable is what you actually have to pay them, so that's what that one is. Okay, so this is the entry to record the wages payable and the work in process, and then the variances at the same entry. Okay, again, this entry here is going to be used for closing entries. Okay, and we'll do it the same way. Since labor rate variance was a credit, we'll debit the account here. Labor efficiency variance was a debit earlier, so that will be a credit here. And then the cost of goods sold is simply the difference between the two. And that can be either a debit or a credit. In this case, it's 1775. Okay, so again, we'll take the 11,200, which was the actual units produced, times 0.75 to get 8,400. The 8,400 hours is our standard hours allowed for 11,200. Times our standard wage of $12 gives us 100,800. 8,500 is the actual hours you worked. $12 is our standard for 102 for a labor efficiency variance of $1,200. The rate variance is the 8,500 times the 1165 for 99,025, and the difference between those two is 2975. That's how much. Basically, we said we was going to pay him $12, but we only paid him $11,765. And this gives us the indication of where we start looking for, because you're saying, okay, it may be we have a lot of new employees coming in. That's why we didn't pay them the $12. New employees are not as efficient, which would explain why this was unfavorable and this was favorable. Okay, or we may not have given them the raise we thought we was going to, you know, or that type of thing. And also we have to look into the material quantity variance. Well, that's favorable, so that's okay. So they're doing okay. They're just maybe, you know, we just didn't pay them a raise, or we have $12 coming up for a wage, but we haven't got there yet, and that's why it's still $11.65. In a couple months it will be. So this just raises questions as to what we need to start looking for. All right, that's it for this one, and the next one's on overhead.